Kestenbaum, Chairman of Bedrock Industries. Good to see you at this steel conference in New York.
Good to see you. Thank you for having me.
I guess we should explain a little bit about what Bedrock Industries does.
Sure. Well, having come off my recent work at Ferroglow, which I founded about 12 years ago, which became the largest ferroalloy producer in the Western world, I decided to start something new, and I started a fund actually about a year ago. And what we wanted to do is really distinguish ourselves from others, which is others are capital providers. I bring capital, but also bring operational expertise and strong relationships within the industry. So we've been able to differentiate ourselves by doing that. And in fact, right now, getting very close to closing a large transaction in the steel industry, which is why I am here today to attend this conference.
So why is the steel industry, in your mind, attractive for new investment right now?
Well, there are parts of the steel industry that are actually not attractive. So it's not necessarily a statement about the macro situation in the steel industry. I've always approached investments on a buy versus build type of model, which is to buy something that exists, buy it at the right price, clean up the balance sheet, which is absolutely critical. It's a very, very cyclical industry. And we all know it goes up and down. It's never going to last when it goes all the way up or when it goes all the way down. And so you need to be able to be prepared for those down situations, which means low leverage, and it also means keeping your legacy liabilities in check. So when I approach this opportunity, we all know that steel business is good right now, and hopefully it'll last for a while longer, but I really focused on costs, and especially costs of financing and costs of legacy liabilities. And here we were able to design this transaction to achieve that and basically create a healthy, from a financial perspective, company with excellent assets that we'll be able to use as a platform to continue to make further investments in the steel industry.
So on the subject of cost of financing, financing costs have been low, unusually low, for about a decade now. So is there much savings to be made by restructuring on the finance side?
So when I say low financing, I mean actually low aggregate levels, not necessarily interest rates.
Gotcha.
Interest rate is the cheapest part of it. The biggest part of it is when that debt comes due and you happen to be at a window where the debt markets have shut or the steel market is not doing well. And then what do you do? And we've seen what happens. Many of them file for bankruptcy. So the way to get through those periods and be able to be the company that doesn't get swallowed up, but rather the company that swallows up others, is to be able to keep your leverage low, your capital structure flexible, so that you can actually grow when everyone else is shrinking.
Do you think the industry overall has learned from the last downturn that prompted so many to go out of business?
I think not. I think you look at some of the large companies, and we say large companies, they're actually not large companies. They're large relative to the industry, but they're not large companies. And they really can't get out of their way. How do you erase decades of legacy liabilities? How do you erase the lack of being able to generate sufficient capital to grow your business other than accessing the debt or equity markets? You can't do that. So it means your equity is constantly getting knocked down. You're constantly increasing your debt just to sustain your business. So there's not a lot that they could do about it. And then still others go and invest in brand new plants, taking on billions of dollars of debt that in the next downturn they're going to have a very, very hard time repaying. So I go back to this theme, and it's worked for me before, where I first bought 10 companies, merged with our largest, and created a company with low leverage and no legacy liabilities. And that really gives you the flexibility to grow. And that is how we approach building our business.
What happens in these situations where even not so much building new plants, but just to modernize these plants? And we've heard so much at this conference about new technology, and that's expensive to put in.
And that is critical. And that's yet another reason why you want to have low liabilities, because you need to invest in this business. You need to invest in equipment. You need to invest in certain technology. On the other hand, you can't get ahead of your skis. You have to know who you are. We know who we are. We're not going to be able to compete on technology with Nippon Steel or with POSCO that invest $50–100 million a year in R&D. We're not going to get there. So we also have to know who we are and what we are, and stay close to our customers, develop products that they can use without necessarily trying to be superstars either.
Well, it'll be interesting to watch the progress of your fund. Alan, thank you so much.
Thank you for having me.